Hey, welcome back everyone. So my name is Zach Vines, and in the previous video, the Accrual Accounting Explained video, we talked about just the general notion of accrual accounting, basically talking about that cash comes later, right? So if you're selling a product, you're providing a service, and you do it on account. The person buying that product from you, who's getting that service from you, isn't giving you the cash up front, but you're basically putting it on their tab. You get to recognize the revenue now, but in turn, you create a receivable account, meaning that you're going to receive that cash from them at a future point in time, right? Whereas if you're the purchaser, you are going to recognize a payable, meaning that you don't have the cash right now, you haven't given them the cash quite yet, but you're going to go ahead and recognize your expense and create your payable, okay? So that's pretty much where we're sitting right now. So pretend that some transaction has occurred where the seller recorded their receivable, the buyer recorded their payable, and we're just waiting for the cash to happen. Okay, well, it's a sad reality of life that not everyone is going to pay every last dollar on their accounts, right? It's pretty much just saying that as a business, we recognize we're not going to collect every last dollar from our accounts receivable, right? Just not everyone makes true on their bills, and it may not be their fault, maybe something super unforeseen happen with their business where they don't have the cash now. Maybe they will end up paying us at a future point in time, but as conservative accountants, we never want to overstate our financial position, right? We never want to inflate our revenues or underestimate our expenses and make our financial position look better and more robust than it actually is, because that's how you oftentimes get in trouble. And so what we do instead is that we create an estimate at the beginning of the year, and you can use it based on a lot of different methods to come up with this estimate, and we'll go into those in a future video. But you can do it on a percent of sales that tend to be uncollectible, just based on historical trends. You can come up with these estimates. But essentially, what allowance for doubtful accounts is a provision that we're creating. It's an estimate saying that, okay, realistically, we know we're not going to collect every last dollar from our accounts receivable. Not everyone's going to make true on their bills. There's going to be something sitting in that accounts receivable that we're just not going to be able to get rid of, right? So what we do at the beginning of the period is we go, okay, well, we are not going to collect every last dollar. So let's create some sort of provision, some sort of allowance for those accounts we think we might not collect, so we're not overstating our position. So even when you look at the name Allowance for Doubtful Accounts, it kind of makes sense because it's an allowance you're making, a provision you're making for accounts that are doubtful, for ones that you may not collect every last dollar on. But it's an area we tend to struggle with a good bit because it gets more into the estimating conceptual nature of accounting, whereas many times, oh, we're paying cash for a service, so we recognize, cash goes out the door and we recognize an expense. Or we sell a product, you can almost see in your head the ins and outs and you're counting the things that are right in front of you. But in the background, there's so much more going on with accounting that we actually have to account for. That isn't just counting the nuts and bolts that are right in front of us. It's representing our true financial position without overstating anything, and allowance for doubtful accounts is a big way that we do that. And so when we're first talking about recording our allowance for doubtful accounts, at the beginning we go, okay, well, we think our allowance for doubtful accounts is going to be some amount. And like I said, the way you come up with that number can be based on many different methods that we'll get into in a future video. But for right now, just initially recording it, what do you debit, what do you credit? You debit something called a bad debt expense. Another word for this, or another account title I've seen in place of this, is an uncollectible accounts expense, which I almost like better, but in practice I've actually seen bad debt expense used a little bit more. So bad debt expense and uncollectible accounts expense, you can make them synonymous for right now. It's the expense we're recognizing on the front end to associate with our allowance for doubtful accounts. And to credit, it's going to be, an allowance for doubtful accounts. So one thing I want to point out about allowance for doubtful accounts is this is known as a contra asset, okay? So remember, with the accounting equation, we have assets equal liabilities plus stockholders' equity. Let's talk about the assets for a moment. We have the debit and the credit, and debits increase assets, credits decrease assets, right? So an asset holds a debit balance, okay? Well, when we're talking about an allowance for doubtful accounts, it's really kind of offsetting our accounts receivable. And by that, I don't mean that we're literally reducing the balance in our accounts receivable. Our accounts receivable is our accounts receivable. We're keeping a running tally of all the cash we expect to receive. But our allowance for doubtful accounts is kind of a separate line item that we're using to offset and truly represent what we think we're going to collect from our accounts receivable, kind of net of that allowance for doubtful accounts. So when I say it's a contra asset, it's a credit because it contradicts. So think contra contradicts. the true nature of an asset, where it increases with a debit balance, right? Well, it decreases with a credit balance. And for this to be a provision that offsets our accounts receivable to kind of show that we're not going to collect every last dollar, it's really decreasing the balance in your overall assets, okay? So when you credit an allowance for doubtful accounts, that increases the balance in that allowance for doubtful accounts. But in turn, what that does to your overall assets, it actually decreases it, because if it's a credit increase here, apply that credit to the asset, it's going to end up decreasing. So very important to know that that's a contra asset. So that's the initial record of it, is just to debit your bad debt expense or uncollectible accounts expense, so kind of be careful to look for both of those, and you credit your allowance for doubtful accounts. So let's say some time goes by. So you create that at the beginning of the year. You go, okay, we're going to do our transactions and everything. Hopefully we collect more. Hopefully our estimate isn't too crazy and we're just not going to collect a lot of the money from our accounts receivable. But over time, somebody who bought something from you on account, you wait and you go, okay, they'll probably pay us back. Okay, it's kind of getting a long time now. They haven't paid us back. What the heck? You call them, you do whatever you need to try and get your money. At a certain point, whatever that is for your own company, whatever the threshold of no return is for you, you go, okay, they're not going to pay us. Let's just go ahead and write off this account and just not fool with it anymore. We don't expect to receive it. They're not going to pay us. We're just going to chalk it up as a loss, essentially. So to write off an allowance for doubtful accounts, what you're doing is, first of all, the first thing that I think of that's really easy to remember with the write-off is that the accounts receivable is what I expect to collect, right? Well, if I'm writing something off, I'm accepting the fact that I'm just not going to collect that accounts receivable anymore. Well, if that's the case, why would I keep that in my receivable? Receivable means I'm going to receive it, right? Well, if we're accepting that, no, I'm just not going to receive it, well, then I need to reduce the balance in my accounts receivable by crediting it, because an assets increase with a debit, decrease with the credit. So I'm going to decrease the balance in my accounts receivable, because I just know I'm not going to receive it anymore, or at least I don't think so, and that's how we're going to book it in our journal. And so we have a credit here. Well, allowance for doubtful accounts debit. Well, why do we do that? The logic that I think of in my head that really helps me out with it is basically allowance for doubtful accounts is an estimate of what we think is going to be uncollectible, right? Well, if I now know I'm not going to collect a certain part of it, or at least I accept, as far as my books are concerned, that I'm just not going to collect some amount from this customer, I want to refine my estimate. I want to make it a more accurate estimate of what I think I might not collect by reducing the balance in that allowance for doubtful accounts. So remember, it's a contra asset, so it holds a credit balance. That's why we increased the balance in it when we first created that allowance for doubtful accounts. Well, now I know I'm going to write it off, that I'm not going to get it anymore. So let me make my estimate a little bit more accurate and reduce my provision that I've made by the amount I know is not going to be collectible anymore, or that I think is not going to be uncollectible. And so that's how you write it off. All right. The big other journal entry we'll talk about and close out with this video is, let's say I wrote you off. I know I'm not going to collect your account anymore. And then you come back. Suddenly, you just emerge from the ashes and go, hey, here's your money. Sorry, I was gone for a while. Here's your cash now. And we go, oh, what the heck? Okay, cool. Well, I already wrote you off, so what do I do about that? Actually, very simple. You're just going to reverse the write-off. So right here, we debited allowance for doubtful accounts and we credited accounts receivable, right? Well, I debited it to refine my estimate. Well, I have it now, so let's reverse exactly what I just did a moment ago. And now I'm like, oh, well, my accounts receivable was at this amount. I wrote you off, but now you're back. I'm just going to completely do the opposite of what I just did right here. Instead of debiting allowance for doubtful accounts and crediting AR, I'm going to debit AR and credit allowance for doubtful accounts. But that's just to get you back to where you were before that happened, like essentially as if you had never written it off. But now what you're doing is you got the cash, right? So you received the cash now. So you go, okay, now let me debit the cash because they showed up out of the ashes and gave me my cash. And then let me credit my accounts receivable. Because think, if you didn't do this reversal right here, your accounts receivable was sitting at some amount, okay? And then you wrote it off. You go, oh, I'm not going to collect it anymore. So you reduced the balance in that account. If you never reversed the write-off once they showed back up and gave you the cash, and you just debited cash and credited AR, it's even lower than it was. So you need to put it back where it was so you can properly reduce it by the amount that you actually received. Pretty much put yourself at 0.0 as if you had never written it off, because it's usually a fairly unforeseen thing. If you're going to reverse the write-off, you're normally not going to write something off unless you're fairly confident that you're not going to receive it anymore. And so you're pretty much putting yourself back into the position you were before. You recognize the cash like normal, and you're good to go. And so, like we said, there's a few methods that you can use to actually estimate what your allowance for doubtful accounts is. So we'll get to that in the next video.